Today, a spotlight on Gordon in New South Wales. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctly Australian flavour. Today I wanted to take you through my detailed analysis of a postcode called Gordon, which is just on the northern shores of Sydney. And Gordon is one of those leafy suburban areas with good access to the city and seems to be doing relatively well, but nevertheless there are some interesting stress signs if you look below the waterline. Now, as always, I need to caveat this by simply saying that this is based on the currently available information. This is not financial advice, and you should not take it as such. It's merely using the information I have available, and of course this information may well change ahead. But nevertheless, it does provide an interesting snapshot of a postcode which I find quite fascinating. And just to remind you that I'm using my core market model, which includes information from our consumer surveys and other data sources. It goes into the core market model, 52,000 households each year, and the data is current up to last Tuesday. And that drives a lot of analysis that we do. And one of the things that we can look at then is mortgage stress, the price trajectory, the buying and selling intentions, the migration statistics, and also the economics, things like CPI, wages and employment. All of that goes into the core market model. The core market model also contains our various scenarios, which means that we can then look at the region, state and all Australia data and also form a view as to what prices might be doing at the moment. So let's look at Gordon, which is postcode 2072. It is north of Sydney CBD, up the Pacific Highway, in fact, which runs right through the middle. And it's a relatively contained postcode, but it is also quite diverse. Now, Gordon is described as a suburb on the upper north shore of Sydney in the state of New South Wales, 14 kilometres northwest of Sydney Central Business District, and it's the administrative centre for the local government area of Ku-ring-gai Council. And here are just a few photographs of the area. This is looking up the Pacific Highway. You can see the significant road traffic that runs through the particular postcode, and some of the buildings there which are commercial buildings running up the strip. Now this is a picture of the station car park. Many people commute into the city here, and so there is a lot of parking required. It gets quite busy morning and evening, and that's true also because there are some local schools which are serviced by the same facilities. Away from that, it gets quite leafy. The streets are in some cases a little narrow, but you can get away from the Pacific Highway bustle quite quickly, and it's quite tranquil. Many of the properties in the area are quite palatial, and it has tended to be an area where single properties on large lots are definitely flavour of the month. However, that is changing, and in fact directly opposite this one, you have these. And in fact, we're seeing a lot of knockdowns and rebuilds where property is being converted from a single house on the lot to multi-units. And in fact, there is a higher density now of units in this postcode than we've ever seen before in this area, and more coming. So now let's look at properties for sale. We'll start with houses, and there are at the moment 4 houses for sale in Gordon. Here's a map showing the distribution. And here is a little bit of information. Shows you that there isn't a lot of price information. There's some price guide 2.4 to 2.6 for the first one there, and then contact agent, and just for sale. Very hard to get good information as to what might be going on. But you can also see that some of them are old style, others are much more modern. If I turn to units in Gordon, there are 15 units for sale at the moment. And again, here is the map showing the distribution. A lot of them are quite closely clustered around access to the station. And you can see that a lot of them are on Pacific Highway or just off it. And you quickly get the sense that there is a lot of high-rise development in and around Gordon. And of course, it's been zoned for high density development. So the area is changing fast, particularly close to the Pacific Highway. Now, quite often with some of these units, you get a sense of they're not telling you the whole story from the hero shot. And I'll also highlight that quite a few properties don't really contain much price information on the listings. So let's now turn to sold properties in Gordon, and we'll start with houses. There are 3 properties sold in the last 8 weeks in Gordon. And here's the map. And here are the properties. And you can see there that in each case the portal is reporting last asking price. That does not necessarily translate to the deal price. It's one of the big problems with the portals at the moment. In terms of units, 5 units sold in the last 8 weeks in Gordon. Here's a map. Here are details of the properties. Once again, last asking price, sometimes including a range as well, so that tells us even less about what's going on. Some of them are modern, some of them are older style. Now let's look at current price trends. Now we're going to look at houses first, and this is the median trend. The median price in 2013 was 1.5 million. It rose 18.3% to 1.775 in 2014. It went up 21% in 2015 to 2.15 million. It fell slightly in 2016. It rose strongly in 2017 to 2.6 million. That was a lift of 26.4%. It fell in 2018, down 10%, fell in 2019, and rose very slightly in 2020 to give a median price of 2.3 million. And that translates to an average gain of 6.7% since 2013, or after inflation, 4.8%. So you can certainly conclude that this is an example again of prices not doubling over 7 years. Now, if we look at Gordon units, you can see there that in 2013, $700,000 was the median price. It went up 7.1% in 2014 to $750,000, went up 16.7% in 2015, up again 5.7% in 2016, fell slightly in 2017 to give $910,000, rose in 2018 to a median of $940,000, fell in 2019 and fell again in 2020 to give a current median price of $870,000. And that means that between 2013 and 2020, the average gain was 3.3% per annum, or after inflation adjustment, 1.4%. So again, more evidence of prices not doubling every 7 years. Now, we can get value or general information for properties in this area, and you can see there that there are considerable ranges both in terms of property area and also prices. That's the whole point about a median, because of course properties do vary by each individual location. But you can see that there's quite a lot above 2 million, a few a little lower. Now, if I compare that to units, again, we can see quite a lot of information there. And there are quite a few prices down among 800, 900, and some lower and some a little higher. And just to underscore again, this value of general information is available to the public. Just go to the New South Wales Value of General site and you can actually then query it. There's one catch: you can only get 100 entries at one time. So let me now summarise Gordon. There are around 50 listings there, with 10 added in the last month. In May 2019, listings were higher at around 87, but only 28% of those are houses, the rest are units. And that's really the point. Gordon is going through a significant transformation with more high-rise development and also subdivisions for townhouses and low-rise development. And that is because of the development plan that exists there. The gross yields for houses from an investment perspective are around 4.3%. That's a fall from 4.5% last year. The net yield is around 2.75% and is falling. Units, the gross yields are lower at 3.1%. That's a fall from 4% last year. The net yield is around 1.5% and is falling. The rents for houses are falling, down 20.8% in the last quarter, with a typical rent of around $800 a week, whereas rents for units are rising, up 3.8% over the past quarter, with a typical rent of $520 per week. The vacancy rates are very high, 7.7%, but that is down compared with 10.5% in mid-May 2019. There's about 85 vacancies now, compared with 105 then. The asking price for houses is on average flat at the moment, with a typical house price of $950,000, and the average settlement, so in other words, what happens between the asking and settlement price, is roughly a 5% fall at the moment. Units are having asking prices rising about 11% over the quarter, with a typical unit price of $860,000. The average settlement is around 7% lower than asking, and the intention to sell is rising slightly. So let's now look at the stress information from the DFA model. I've also included St Ives because it makes quite an interesting contrast. St Ives is slightly further out and is a slightly bigger postcode. So in Gordon, there's about 2,800 households, 1,000 borrowing, 1,000 renting, about 818 rental properties, and around 1,300 property investors living in the area. The overall financial stress metrics in the postcode is at 43.3%, which is lower than St Ives at 50.8%. Now, amongst homeowners, only 340 are actually registering in mortgage stress, but an additional 220 are in severe mortgage stress, meaning they're severely underwater with cash flows. And that translates all up to about 33.4% of households who are borrowing. And the default rate is quite high at 6.7%. So we think some of this is going to come unglued over the next few months. And that's because a number of households here are still on principal and interest repayment holidays and may well have to make alternative arrangements in the future. Now, if you compare that to St Ives, you can see there that there's a rather similar proportion of households in stress at 34.8. Defaults are pretty low, though, and that's at 2.7%. So there is a considerable difference between Gordon and St Ives in terms of the prospect of default over the next 12 months. That said, rental stress has a different story to it. So in Gordon, only 6.2% of people in rental stress, which means it's very low, whereas 53.8% are in rental stress in St Ives, which is more than 900 households. So that's a potential pressure point with regard to some investors. And turning to investors, you can see that around half of property investors in the postcode are stressed at the moment, 71 severely stressed. That doesn't mean that they've necessarily got an investment property in the postcode, but it means that that's where they live. St Ives, 43.5%, so a lower level of investor stress, and around 1,200 stressed investors, of which 91 are severely stressed. And so finally now we go to our scenarios, and firstly we look at the scenario for houses in Gordon, and we have our three cases, the low case, the base case and the high case. The low case is our least risky scenario, and in that scenario we expect prices to rise higher over the next 2 or 3 years, cumulatively up about 3.6% over 3 years. On the other hand, if the virus comes back and more pressure is put on the economy as a result of it, we still think there could be falls, and that could be around the 14% mark over 3 years. The base case, which is the one we use for our modelling, assumes that the virus will come and go. It assumes that the vaccine rates will be slower than some are anticipating, but nevertheless will reduce the risk through next year. And it assumes the international borders will open towards the end of next year. In that scenario, we see a 5% fall over 3 years. And translating that to price movements, so today the median price is 2.315 million, and we could see a fall of 3.6, 3.7, and a rise of 1.7, leading to a small improvement over that third year, but nevertheless overall prices down at 2.185 million, which would take prices back to where they were in 2016. So now let's look at Gordon unit scenarios. And in that scenario, in the low case, prices could be up about 4.8% over 3 years. In the high case, down 25%, and the base case down 9.8%. And translating that to real numbers, $870,000 is the median price for a unit in Gordon at the moment. That could fall over the next year, fall a bit further in 2022, and then rise in 2023 to $785,000. And if that were to be true, then we would see prices back to where they were in 2014-15. So in summary, you can see that this postcode has some attractions, access to Sydney. It's also got a significant development profile with a lot of high-rise buildings and more planned, and a lot of subdivisions. And so anybody buying a house there is going to compete with builders looking to subdivide. That said, away from the Pacific Highway, it's much quieter and therefore is highly attractive, and that helps to support prices. Nevertheless, we see some pressures over the next 12 to 18 months simply because of the fact that people are highly leveraged to an extent, and property investors are not necessarily seeing the returns they expected. Therefore, our overall expectation is that prices will go sideways, might go up a bit, might go down a bit, but we don't see a massive acceleration in value over the next year or two. And that's worth reflecting on, given all the spruiking that's out there. Sure, units will perform probably worse than houses, but even houses may not necessarily perform as well as people expect. And I'd highlight again the low transaction volumes at the moment in the light of the fact that we're going to see more listings coming on after Christmas, after the new year, as more people face up to their financial obligations. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.